If you're like me, your paycheck looks bigger on paper than it did 5 years ago, but your life actually feels smaller. Rent is up, insurance has doubled, the math isn't mathing.
I'm gonna be homeless, no car, nothing. My world is gonna go drop, and what am I gonna be doing? I'll be completely 100% homeless.
Across the US, the UK, Canada, and Australia, we are all staring at the same impossible equation. GDP is hitting record highs. Productivity is climbing. Yet, stability, the thing our parents treated as a default setting, is now a luxury product. Most people think this is just inflation or bad luck. It's not. It's a specific architectural change in how money moves. We have quietly split the economy into two distinct operating systems. One system governs labor, the money you earn with your time. The other governs ownership, the money that earns itself. And the code for this first system is broken. There was a time when the economy grew and your life grew with it. For about 3 decades after World War II, the machine ran on a different operating system. When productivity went up, paychecks went up with it. A factory worker in 1955 could buy a house on a single income, raise a family, and retire on a pension his employer paid for. Not because life was cheaper, but because the rules of the game forced growth to flow outward. Housing cost roughly 2 to 3 times a typical annual salary. Mortgages were usually 15-year commitments you could actually finish. Credit cards barely existed, and most families carried almost no revolving debt because the system didn't need them to. The safety net wasn't a slogan, it was policy. Retirement was guaranteed, not gambled in the stock market. Public money built highways, schools, and hospitals that cut real costs for everyday life. Financial regulations put guardrails around Wall Street so it wouldn't swallow Main Street whole. And workers had leverage. Unions weren't just a logo on an old jacket, they were a transmission belt. When companies earned more, organized labor made sure wages rose with profits. When labor doesn't organize, those gains don't disappear, they simply flow somewhere else. Tax policy locked this architecture in place. During the Eisenhower years, top marginal tax rates in the US sat above 90%. If you were already rich, hoarding profits made less sense than reinvesting in workers, equipment, or communities. The code made extraction expensive and sharing rational.
Is far from being achieved. In the United States, 40 million people are living below the poverty line, and millions of workers will go to great lengths to stay above it.
None of this was accidental. These outcomes were the result of laws, institutions, and social norms that deliberately channeled economic growth toward broad prosperity. The middle class wasn't a happy side effect of capitalism, it was engineered. And once you understand that it was built, you see the darker implication. Anything built can be unbuilt. The same levers that spread prosperity can be pulled in reverse. The same rules that distributed gains across millions of households can be rewritten to concentrate them in a few hands. Starting in the late 1970s, that's exactly what happened. Since the late 1970s, someone rewrote the code of the economy. Here's how you can see it. Take 2 lines. One line is productivity, how much value workers create per hour. The other line is typical worker pay. For most of the 20th century, those lines moved almost in sync. When workers produced more, they earned more. Growth showed up in real paychecks. Around 1979, the lines split apart. Productivity kept climbing, typical pay flattened. That gap is not an accident. It happens when 3 levers all get pulled in the same direction.
Becoming homeless overnight is what these Americans fear most, because here, the system is not very kind to those short of cash.
First lever, bargaining power. In the 1950s, more than a third of private sector workers in the US were in unions. Collective bargaining meant that when companies became more profitable, workers could demand their share. Today, that number is closer to 6%. In most workplaces, you negotiate alone, against a corporation with lawyers, data, and global options. When organized labor disappears, profits don't. They just stop flowing to wages. Second lever, globalization as a threat. Starting in the late 1970s and accelerating through the 1990s and 2000s, companies gained the ability to move production almost anywhere on Earth. For a worker, that meant every wage negotiation came with a silent message. Accept less, or we can move this job somewhere cheaper. You don't need to actually close the factory. The credible threat is enough to hold wages down. Third lever, deregulation and the rise of finance. Over the same decades, financial rules were loosened. The mission of the corporation narrowed from serve customers and communities to maximize shareholder value. Executive pay shifted from salaries to stock-based compensation. When the stock price goes up, executives win. When it doesn't, they're replaced. This is where one quiet rule change becomes the master key. In 1982, the SEC created Rule 10b-18, a safe harbor that effectively legalized large-scale stock buybacks. Before that, a company aggressively buying its own stock could be treated as manipulating the market. After 10b-18, it had a green light. Here's how the new code works. Instead of using profits to raise wages, expand production, or improve benefits, companies can use those profits to buy their own shares. Fewer shares in the market means each remaining share is worth more. And because executives are paid in stock, buybacks directly boost their net worth. Between 2010 and 2019 alone, S&P 500 companies spent over $5 trillion on stock buybacks. That money could have funded wage increases, new jobs, or lower prices. It funded bonuses instead. So you have three forces all pushing in the same direction. Workers lose bargaining power. Global competition keeps them scared. Financial rules reward executives and shareholders for extracting cash instead of sharing growth. On a chart, it looks like two lines splitting apart. The distance between those lines, the widening gap between what workers produce and what they're paid, is where the missing middle class went.
My mom stretches the money that she gets to last out the whole month, but some things I can't get that I want. The grocery stores are running out of supplies and stuff, toilet paper, bread, meats, a few things.
This wasn't a single dramatic robbery. It was a 40-year slow drain, executed transaction by transaction, policy by policy, rule by rule. The middle class wasn't just left behind, it was systematically unbuilt. Your house used to be where you lived. Now it's a financial product. With paychecks no longer keeping pace, families needed a new engine for building wealth. The economy found one by converting essentials, shelter, retirement, education, healthcare, into tradable assets. Your rent, your home equity, your 401k, your degree, all of it now generates returns for distant investors. Housing became the flagship example. Harvard's Joint Center for Housing Studies tracks what's happening. The U.S. home price-to-income ratio hit a record in 2022. The median single-family home reached 5.6 times median household income nationally. In Honolulu, that ratio climbed to 12.1. When the primary path to wealth runs through home equity, rising prices create winners and losers simultaneously. Owners watch their net worth climb, potential buyers get shut out permanently. The same price gains that build generational wealth for one family lock another into renting forever. And the speculation feeds itself. Rising prices create the narrative that housing is safe, which pulls in more capital from investors, pension funds, and private equity. More capital pushes prices higher. Higher prices force bigger mortgages. Bigger mortgages mean more household income flows to banks instead of savings. Then retirement followed the same transformation. Employer pensions once promised a specific monthly check regardless of what markets did. That model is largely gone now. Today, middle-class retirement rides the S&P 500 through 401k accounts and IRAs. When markets crash, retirement plans crash with them. The risk shifted from corporations to kitchen tables. And finally, education and healthcare complete the picture. A college degree that cost a summer job in 1970 now requires years of debt. Medical bills remain the leading cause of personal bankruptcy in America, not because people get sicker, but because the system extracts more. Every essential has become an investment vehicle for someone else. And when wages can't cover the entry price, the economy offers one solution: borrow your future and call it the present. Banks don't primarily lend out existing deposits. They create new money when they issue loans. Every mortgage, car loan, and credit card balance expands the money supply itself. This mechanism props up the middle class in a specific way. Borrowing lets households keep buying homes, degrees, cars, and even healthcare when real wages haven't budged in decades. It masks the stagnation. The gap between what you earn and what things cost get bridged by income you haven't earned yet. According to Federal Reserve data, U.S. household debt relative to GDP peaked around 2007 at roughly 100% of economic output. Families owed as much as the entire country produced in a year. When your security runs on leverage, small disruptions become catastrophes. A job loss doesn't mean temporary belt tightening. It means missed mortgage payments, triggering late fees, triggering credit score damage, triggering higher insurance premiums. One thread pulls and the whole fabric unravels. Interest rate changes reshape monthly budgets overnight. A mortgage at 3% versus 7% on the same house means hundreds of dollars difference every single month. Central bank policy becomes a household variable that families cannot control but cannot escape. Debt also shifts bargaining power in ways that rarely get discussed. A worker with high fixed payments cannot easily strike, quit, retrain, or relocate for better opportunities. Leverage quietly disciplines labor. It makes workers more compliant because the consequences of disruption become so devastating. It's not that the middle class became reckless. They actually became structurally dependent on credit because the pay-to-cost gap had to be bridged somehow. But this arrangement only holds when credit flows freely and rates stay friendly. Entire economies now depend on monetary conditions nobody voted for. The system needs people borrowing to function and needs them too indebted to push back. But debt is only half the equation. The other half lives in a tax code most people never read, but the wealthy know by heart. The tax system has one simple feature. Owning things is taxed lighter than working for them. In the United States, the top rate on long-term capital gains sits at 20%. Ordinary income, the money you earn from your job, faces a top rate of 37%. Work harder, pay more. Own assets, pay less. This gap compounds over time. If your wealth grows through assets that appreciate and you're taxed less when you sell, your after-tax returns beat wage earners before inheritance even enters the picture. The advantage is exponential. The wealthy have optimized this into a 3-step machine. Step 1, buy stocks or real estate that grow in value. Step 2, borrow against those holdings for spending money instead of selling them. Banks love lending to billionaires at low rates when their collateral keeps climbing. Loans aren't taxable income, so no tax bill arrives. Step 3, when you die, heirs inherit at a stepped-up basis, the current market value. Decades of gains, never taxed, completely legal. And debt works differently depending on which side you stand. Middle-class families borrow to survive. Mortgages, car payments, medical bills. Asset owners borrow to avoid selling and amplify returns. Same verb, different universe. These rules create consequences beyond individual wealth. When effective tax rates on top incomes shrink, government revenue shrinks with them. The programs that once supported the middle class, public education, healthcare, retirement security, get thinner every budget cycle. The incentive structure reinforces itself. Preferential treatment pushes more capital into assets. More capital chasing assets inflates prices. Higher prices widen the entry gap for anyone starting without wealth. Ownership becomes self-perpetuating. Wage dependence becomes a trap. This design doesn't need a secret meeting to function. The rules do exactly what they were written to do. And when a shock hits the economy, those rules decide who gets rescued first. You can think of crises like an economy's X-ray. They reveal what the structure actually protects when it panics. The 2008 financial collapse was the first clear exposure. When the housing bubble burst, the damage hit exactly where ordinary people stored their wealth, their homes. Families who treated their houses as retirement plans watched everything evaporate. A leveraged household losing a home through foreclosure experiences total reset. Savings gone. Credit destroyed. Years of payments vanished. A diversified investor losing paper wealth on our portfolio often just waits. Policy backstops stabilize markets. Paper losses reverse within months or years. Banks got liquidity injections. Homeowners got paperwork. Then came COVID. 22 million Americans lost jobs in the first months of the pandemic, while asset markets recovered faster than anyone predicted. According to analysis from the Institute of Policy Studies, U.S. billionaire wealth jumped roughly 70% during the pandemic, from approximately $2.9 trillion in March of 2020 to over $5 trillion by October 2021. That's $2 trillion transferred upward while tens of millions experienced income collapse. The mechanism is quite straightforward. Liquidity support and low interest rates boost the present value of financial assets. People who already own them receive the rebound as a wealth event. People who depend on wages receive nothing until hiring resumes. Renters faced surging costs as housing prices rebounded faster than incomes. First-time buyers have watched the goalposts move further and further away with every passing month. Households with variable rate debt felt the squeeze from both directions. Shocks accelerate what's already happening. Protect ownership first. Hope labor catches up later. The middle class is visibly shrinking. The question now isn't why, it's whether anything will reverse it. No conspiracy runs the system. When returns on assets outrun wage growth, ownership quietly absorbs more and more of the economy. The middle thins out. Stability turns into a gated community. Access to assets starts to matter more than effort ever could. The cruelest part is that people blame themselves because the system sells personal failure as the explanation. Work harder, budget smarter, hustle more. Meanwhile, the real causes are structural forces you cannot out-hustle, no matter how many side gigs you stack. Societies can write rules that push growth into wages and affordability, or they can write rules that push growth into asset prices. Both are policy choices. Societies can write rules that push growth into wages and affordability, or they can write rules that push growth into asset prices. Both are policy choices. Neither is a law of nature. So, I want to bring this down to you. In your own life, what's the thing that's raced ahead of your paycheck? Rent? Healthcare? Childcare? Something else? And what do you think is actually driving that beyond, I should have tried harder? Tell me in the comments. I read every one. No joke. And if you want to keep pulling on this thread, the next video picks up right where this leaves off. It follows the money into the rules that made this split possible. Watch that next and see how deep the operating system really goes. Thanks for watching.